For 4 chapters, every company we touched sold time, services, an hour of consulting, a month of marketing. But walk into any store tonight, Walmart, Best Buy, your corner pharmacy, and you're standing inside a different animal. These companies sell things. And the moment a company buys products to sell them again, 2 brand new accounts walk into our books. The income statement grows a whole new section, and even the closing entries you mastered last chapter get new players. Tonight, you learn how the real retail world keeps its books. This is Chapter 5, Accounting for Merchandising Operations, and I promise you, you will never look at a barcode scanner the same way again. Back in my university teaching days, students always thought merchandiser meant Walmart, full stop. But there are 2 kinds, and the difference is just who you sell to. A wholesaler buys from the factory in bulk and sells to other businesses. A retailer buys from the wholesaler and sells to you, the final consumer. Watch the phone travel. The manufacturer makes it. The wholesaler moves thousands of them. The retailer, Walmart, Amazon, Best Buy, Home Depot, puts one in your hand. Both the wholesaler and the retailer are merchandisers because neither one made the phone. They bought it to sell it. That's the whole definition. Buy goods, sell the same goods, pocket the difference. 2 new accounts, and you already know how to read them because you know the equation. Number 1. Inventory. Goods a company owns and holds for sale to customers. It sits on the balance sheet as a current asset, right there with cash, receivables, and prepaid expenses, because in the normal course of business, it becomes cash within the year. Number 2. Cost of goods sold. Accountants say COGS, the cost of the merchandise the company actually sold during the period. That one is an expense. It lives on the income statement. Here's the sentence I want playing in your head all night. Inventory is the cost of what's still on the shelf. Cost of goods sold is the cost of what went out the door. Same goods, 2 accounts, separated by one thing only. Did it sell yet? Remember the operating cycle from last chapter? Cash, back to cash. For a service company, it's short. Perform the service, collect the receivable, cash, done. A merchandiser adds one stop at the front of the loop. First you buy inventory, then it sits on the shelf. Then you sell it, usually on account, then you collect, and finally you're back to cash. That extra stop is why the operating cycle of a merchandising company is ordinarily longer than a service company's. Your money spends weeks, sometimes months, frozen in boxes on a shelf. And a longer cycle means more places for cash to get stuck, which is exactly why merchandisers obsess over how fast inventory moves. Here is the single most useful picture in this chapter, the cost bucket. At the start of the year, you already have goods on hand. Beginning inventory. All year long, you pour purchases in, that's purchases. Beginning inventory plus purchases equals the cost of goods available for sale, everything you could have sold. Now, every single dollar in that bucket has exactly 2 possible exits. Either the goods sold and their cost flows to the income statement as cost of goods sold, or they didn't sell, and their cost stays on the balance sheet as ending inventory. 2 exits, no third door. Now read the formula off the board, line by line, exactly the way you'll write it on an exam. Beginning inventory plus purchases equals cost of goods available for sale minus ending inventory equals cost of goods sold. And here's the exam superpower hiding in it. That formula has 4 variables. Give me any 3, and you solve for the 4th. Professors love hiding a different one every time. Sometimes you hunt for cost of goods sold. Sometimes for ending inventory. Sometimes they get sneaky and hide beginning inventory. Doesn't matter. Plug in the 3 you have, solve for the 1 you don't. And a secret for the road. This formula is exactly how the periodic inventory system computes cost of goods sold. A system where you only find cost of goods sold at the end of the period. We're covering periodic in its own separate Chapter 5 video. Tonight is pure Perpetual, where the formula works as your built-in check. Lock it in, Chapter 6 is built entirely on this formula, and I'm about to test you on it. Quiz number 1 already, because this formula pays your rent on exams. Pause the video. Beginning inventory, $20,000. Purchases during the year, $100,000. Ending inventory, $30,000. How much is cost of goods sold? Work it line by line, exactly like the board. Beginning inventory $20,000 plus purchases $100,000 equals cost of goods available for sale $120,000. Now subtract what's still on the shelf minus ending inventory $30,000. Cost of goods sold. 90,000. If you got 90,000, that's the 4-variable rule doing its job. They handed you 3 variables and you solved for the 4th. And it works no matter which one they hide. Cost of goods sold tonight, ending inventory tomorrow, beginning inventory on the exam. 3 in, 1 out every time. You just solved that formula on paper once with a pause button. Now watch a machine solve it live, thousands of times a day. That red laser at the checkout, the little beep. From my teaching days, I loved asking, what do you think that beep actually does? Students said it charges the customer. Yes, and it does something sneakier. It updates the accounting records. That store runs a perpetual inventory system. Perpetual as in continuous, a detailed running record of every unit, updated at the moment of every purchase and every sale. And here's what I want you to see. 1 beep, 4 accounts moving, across both financial statements. Watch the balance sheet. Cash or a receivable comes in at the selling price. And inventory, a current asset, goes down, the goods just left the shelf. Now watch the income statement. Same beep, sales revenue goes up, and cost of goods sold. An expense account goes up right alongside it. Revenue and its expense recorded together in the same instant, which means gross profit is born on the spot. At any second of any day, the system knows what's on hand and what it cost. So tonight, every time you hear a checkout beep, I want you to hear 4 accounts moving at once: cash or a receivable, inventory, sales revenue, and cost of goods sold. Quiz number 2, and this trap shows up on every exam. Pause the video. Best Buy has 3 laptops. Laptop A sits on the sales floor with a price tag. Laptop B sits on the accountant's desk. She uses it to run the books. Laptop C. Okay, Laptop C is actually a stack of printer paper in the supply closet. Work with me. Classify each one. Ready? Laptop A is inventory. It was bought to be resold. Laptop B is equipment. Same physical laptop, but it was bought to be used in operations, so it gets depreciated like Chapter 3 taught you. And the printer paper is supplies, consumed by the business, not sold to customers. Here's the rule that settles every case. Classification doesn't ask what the item is, it asks why you bought it. Resale, inventory. Use, equipment or supplies. Intent decides. And the baby version, say it like a 5-year-old would. Did you buy that thing to sell it again? Then it's inventory. Did you buy it to use it? Then it's not. That one sentence answers every version of this question they will ever throw at you. So what number do we actually put in the inventory account? Not just the sticker price. The cost of inventory is everything it took to get the goods to your shelf, ready for sale. Purchase price. Freight to bring it in, import duties, insurance and storage while it's in transit, taxes on the purchase. All of that capitalizes, a fancy word meaning it goes into the asset instead of straight to expense. And trade discounts or rebates, they reduce the cost. But some things never capitalize. Freight out to your customers, selling and administrative salaries, abnormal waste, storing finished goods that are just waiting around. Those are period costs, expensed as incurred. And here's why the line matters. If you capitalize a cost that should have been expensed, you overstate net income and overstate inventory on the balance sheet. The books lie in 2 places at once. Auditors hunt for exactly this. Let's run a real company. Maple Street Electronics buys 50 tablets from a wholesaler on account. Invoice price, $10,000. The entry, official form, always. Debit inventory, $10,000. Credit accounts, payable, $10,000. Watch it land on the T accounts. Inventory is an asset, normal balance debit, so the debit side grows by $10,000. Accounts payable is a liability, normal balance credit. The credit side grows by $10,000. Notice what we did not touch. No expense yet. Nothing hit the income statement. We swapped a promise to pay for a shelf full of tablets. Asset up, liability up, equation balanced. The expense waits patiently until the day a tablet actually sells. The tablets are on a truck. 2 questions decide everything. Who pays the freight and who owns the goods while they're rolling down the highway? The sales agreement answers both with 3 letters. FOB, free on board. Here's what those words actually mean. The seller delivers the goods free, at the seller's own cost and risk, only up to one named point. At that point, the goods go on board, and everything after it, the ownership, the risk, the freight bill, belongs to the buyer. So the whole game is, where is that point? 2 choices. FOB shipping point. Ownership passes to the buyer the moment the carrier accepts the goods at the seller's dock. The buyer owns them in transit, so the buyer pays the freight. Real life. Maple Street orders our 50 tablets from the wholesaler, FOB shipping point. The second that truck pulls away from the wholesaler's dock, those are Maple Street's tablets. If the truck crashes on the highway, that's Maple Street's loss, Maple Street's insurance claim, and Maple Street still owes the invoice. That's why we paid the $300 of freight. And pay attention to what happens to that $300 in the books. It is not an expense. It's capitalized, added straight into inventory, because bringing goods to your shelf is part of what the goods cost you. The capitalization rule from 2 slides ago, working in the wild. Now flip it. FOB destination. Ownership passes only when the goods reach the buyer's warehouse. The seller owns them the whole ride, so the seller pays. Real life. You buy a couch with free delivery. Until that couch is sitting in your living room, it's the store's couch. Scratched in the truck, the store eats it and sends you a new one. That's why delivery was free. The seller was paying for the ride, because the seller owned the ride. And this isn't trivia. If a truck full of your FOB shipping point goods is on the road on December 31st, those goods belong in your inventory count, even though you've never touched them. And here's the baby rule, the whole slide in one breath. Whoever owns the goods on the truck pays for the truck. Shipping point, the buyer owns the ride. Destination, the seller owns the ride. Own the ride, pay for the ride. Now let's put that $300 truck bill from slide 9 on the board and watch whose books it lands on. 4 boxes, buyer's books, seller's books, shipping point, destination. Start with our deal, FOB shipping point. The buyer, Maple Street, pays the freight, and because freight in is part of getting goods ready for sale, it goes into the asset. Debit inventory, $300. Credit cash, $300. And the seller's books? Look at the box. No entry, nothing. It wasn't the seller's ride to pay for. Now slide over to FOB destination. This time the buyer's box is empty. No entry. The seller owns the whole ride. The seller records it. Debit freight out. Some books call it delivery expense. $300, credit cash $300. And notice where that lands. Freight out is an operating expense on the seller's income statement. It never touches inventory because it's a cost of selling goods, not of buying them. Step back and see the pattern. Only one side of the deal ever records the freight, the side that owns the ride. Buyer pays freight in into inventory. Seller pays freight out, operating expense. Same truck, same dollars, different books, different destiny. 5 of the 50 tablets arrive with cracked screens, $1,000 of the invoice. And cracks are just tonight's example. Goods go back for 4 classic reasons. They arrive damaged, they're defective, they're inferior quality, or they simply don't meet the purchaser's specifications. You ordered black, they shipped pink. Maple Street has 2 options. Option 1, a purchase return, ship them back, and the seller grants credit against what we owe. Option 2, a purchase allowance, keep the damaged goods, and the seller knocks the price down instead. Different handshake, same entry, because either way we owe less, and our inventory cost is less. Debit accounts, payable $1,000, credit inventory $1,000. Now don't just write it, watch it land. Before the return, the T accounts tell the story so far. Accounts payable holds $10,000 on its credit side, that's what we owe, and inventory holds $10,300 on its debit side, invoice plus freight in. Record the entry and watch both accounts shrink. The debit flies into accounts payable's left side, $1,000, knocking the debt down to $9,000. The credit flies into inventory's right side, $1,000, pulling the goods cost down to $9,300. And notice, the credit went straight to inventory. In the Perpetual system, the inventory account is the running cost of the goods. Anything that reduces what the goods cost us reduces inventory directly. The books track reality, crack screens and all. Now the seller's invoice whispers something to you in code. 210, net 30. Let's decode. The 2, a 2% discount off the invoice price. The 10, yours if you pay within 10 days of the invoice date. That's the discount period. The N30, otherwise the full net amount, invoice minus any returns, is due in 30 days. It's a cash discount. The seller is bribing you to pay early because the seller gets cash sooner and shortens their own operating cycle. You'll also meet 110 EOM, 1% if you pay in the first 10 days of the next month. Same idea, different clock. Watch the timeline, a 10-day green window where the discount lives, then 20 more days where you simply owe it all. Every invoice is a tiny deal with a deadline. Day 8, Maple Street pays inside the window. Careful, the discount applies to what we still owe, not the original invoice. And here's a professional habit that will save you on every exam. When you're not sure what you owe, don't guess. Draft the T account. Sketch accounts. Payable in the margin takes 5 seconds. The purchase put $10,000 on the credit side. The return put $1,000 on the debit side. Pull the balance. $9,000. There it is. Exactly the balance you saw on the last slide. And that's the number the discount lives on. The T account never lies to you. It just adds up what actually happened. 2% of 9,000 is 180. So we hand over 8,820 in cash. The entry, and this one has 3 lines. Debit accounts, payable 9,000, the debt dies in full. Credit cash 8,820. What actually left? And credit inventory 180, because the discount makes the goods cheaper, and in Perpetual, cheaper goods means less cost in inventory. Now watch all 3 lines land. The debit hits accounts payable's left side. 9,000 joins the 1,000 return against the 10,000 we owed, and the account closes to 0. The debt is dead. The first credit hits cash's right side. 8,820 walks out the door. The second credit hits inventory's right side. 180 comes off the shelf's cost. 3 lines, 3 T accounts, 1 motion. Add up our tablet saga. 10,000 invoice, plus 300 freight in, minus 1,000 return, minus 180 discount. Inventory carries 9,120. That's the true cost of getting those tablets to the shelf. Now let's live the other timeline. Same invoice, but Maple Street gets busy. The days roll by, and we pay on day 25. 3 steps, nice and slow. Step 1. What do we owe? Same drill as before. Draft the payable. 10,000 from the purchase, minus the 1,000 return. 9,000. Step 2. Are we inside the window? Look at the clock. The window closed on day 10. We're at day 25. No discount. None. The full 9,000 is due. Step 3. The entry, and notice how boring it is. Debit accounts payable 9,000, credit cash 9,000. 2 lines. No inventory line at all. There's no discount to shave off the goods cost, so inventory never hears about it. Now put the 2 timelines side by side. Pay on day 8, 8,820 leaves. Pay on day 25, 9,000 leaves. Waiting 17 extra days cost us $180. Real money for nothing. Hold that number, because on the next slide, I'm going to show you the scandalous interest rate hiding inside it. 2%, who cares? Every semester, someone said it out loud. So let's build the answer together. Baby step by baby step. No jumps, every number explained. Step 1. What did skipping the discount cost us? $180. That's the 2% we left on the table. 2% is our first number. It's the price of the loan. Step 2. What did that price buy us? Time. If you stretch it all the way to day 30, you kept your cash from day 10 to day 30. Count it on your fingers. 20 days. That's our second number, the length of the loan. So far, so simple. We paid 2% to borrow our own payable for 20 days. Step 3, and here's the only clever part. Interest rates are always quoted per year, so we have to ask, how many 20-day loans fit inside 1 year? Bankers use a 360-day year. It's the old convention, 12 months of 30 days, and it makes the division clean. 360 divided by 20, 18. 18 periods of 20 days in a year. Step 4, if each of those periods costs 2%, then a full year costs 2%, 18 times. 2 times 18. 36% a year. That's the whole formula. The discount percent times 360 over the days you actually borrowed. And now watch it bite our own story. Maple Street didn't even stretch to day 30. We paid on day 25. The same $180 gone, but it only bought 15 days. 360 divided by 15 is 24 periods times 2%. 48% a year. Read that carefully. Paying earlier without the discount makes the rate worse because you paid the same price for less time. 36% is the best case, and no bank on earth charges that for a business loan. My credit card comes close, but let's not audit my personal life. So the rule is brutal and simple. Always take the discount. Even if you must borrow at 10 or 12% to do it, you come out ahead. And real accounting systems are built so no available discount ever slips through. 2 little digits on an invoice, hiding a loan shark interest rate. Quiz number 3, pause and work it. You buy merchandise for $6,000, terms 210 and 30. Before paying, you return 500 of damaged goods. You pay on day 9. How much cash leaves and write the full entry. Ready? What you owe? 6,000 minus 500. 5,500. You're inside the window, so the discount lives. 2% of 5,500. 110. Cash paid, 5,390. The entry, debit accounts payable 5,500. Credit cash 5,390. Credit inventory 110. Did you nail the three-line shape and discount the reduced balance instead of the original invoice? Then you're already thinking like an accountant. And with that, the buyer side of the counter is done. Buying, freight, returns, paying smart, all of it. Time to turn around because now we're the seller. And here it is, the heart of the whole chapter. When a merchandiser makes a sale, one transaction demands 2 journal entries. Burn that in. Maple Street sells tablets to a customer for $9,000 on account. Tablets that cost Maple Street $5,400. Entry 1, the revenue side, at the selling price. Debit accounts receivable, $9,000. Credit sales revenue, $9,000. Entry 2, the cost side, at our cost. Debit cost of goods sold, $5,400. Credit inventory, $5,400. Watch the board. Revenue records what the customer owes US. Cost moves the goods cost off the shelf and into expense. The beep at the register, remember? 2 entries, 2 different numbers, and the gap between them, 9,000 minus 5,400, is the 3,600 of gross profit we'll meet in a minute. 1 sale, 2 entries, every single time. The flip side of Chapter 13, Slide 13. Now we're the seller and the customer brings goods back. $900 of our sale, goods that cost us $540. Could we just debit sales revenue and make it disappear? We could, but management would riot. They need to see how much merchandise comes back. Returns are a symptom of quality problems, so we use a contra-revenue account, sales returns and allowances. The anti-revenue. Look at its T account on the board. Empty, brand new, and read its 2 sides like a map. The debit side is where it increases, the credit side is where it decreases. Its normal balance is debit, exactly opposite to sales revenue. That's the whole job of a contra account. It grows against the account it shadows. And because the sale took 2 entries, the return takes 2 entries. Entry 1, debit sales returns and allowances 900, credit accounts receivable 900. Watch the 900 fly onto the T account's debit side. The anti-revenue just grew, and the only credits this account will ever see arrive at closing time, Chapter 4 style, when it gets emptied into income summary. Entry 2, only if the goods are resaleable. Debit inventory 540, credit cost of goods sold 540, the goods climb back onto the shelf. An allowance, customer keeps the goods, we cut the price, is entry 1 alone. Nothing physically returns. And when our customer pays early, the flip side of the purchase discount. We offered 2, 10, and 30 on the remaining 8,100. They pay on day 7 and keep 2%. 162. Entry. Debit cash, 7,938. Debit sales discounts, 162. Credit accounts receivable, 8,100. Sales discounts, another contra revenue, another debit balance account. Now stack the family. Sales revenue minus sales returns and allowances minus sales discounts equals net sales, the first line of every published income statement. For our little saga, 9,000 minus 900 minus 162. Net sales, 7,938. Why keep the contras separate instead of shrinking revenue? Because each one tells management a different story. Returns scream quality. Discounts whisper about how fast cash comes in. Quiz number 4, the 2-entry rule. No mercy. Pause. You sell merchandise for $2,000 cash. The goods cost you $1,200. Write everything. Entry 1, revenue side, debit cash, $2,000, credit sales revenue, $2,000. Entry 2, cost side, debit, cost of goods sold, $1,200, credit inventory, $1,200. If you wrote only the first entry, your income statement just told a fairy tale. Revenue with 0 cost, profit of $2,000 instead of $800. That missing second entry is the most common student error in this entire chapter. The register beeped, but your books didn't hear it. Both entries in the books. Now comes the payoff for all that discipline. Net sales minus cost of goods sold equals gross profit, and this number is the heartbeat of every merchandiser. Our sale, 9,000 sold, 5,400 cost, 3,600 gross. Divide gross profit by net sales and you get the gross profit rate, 40% here, and that's the number management, banks, and analysts watch like hawks. Why a rate and not dollars? Because a rate travels. You can compare this quarter to last quarter, your store to the store across the street, a corner shop to Walmart. If the rate slides from 40 to 35%, something real is happening. Competitors squeezing your prices, suppliers raising costs, or someone discounting too hard. Gross profit isn't the bottom line, but it's the first place trouble shows. Merchandisers publish their results in one of two shapes, and exams love asking you the difference. Shape 1, the single-step income statement. The definition, word for word. All revenues are grouped into one category, all expenses into another, and net income is found in a single step. Total revenues minus total expenses. No subtotals anywhere along the way. And look at the header while we're here. A formal statement always carries 3 lines. The company name, the statement name, and the period it covers for the year ended December 31st. Pile every revenue in one bucket. Net sales $900,000, interest revenue $3,500, dividend revenue $7,000, gain on sale of land $20,000. Total revenues $930,500. Pile every expense in the other. Cost of goods sold $420,000, operating expenses $180,000, interest expense $1,900, casualty loss $3,000. Total $600, $4,900. Subtract once. Net income $325,600. One step, simple, honest. But look what it hides. Gross profit is invisible. Operating results are mashed together with one-off gains and losses. Simple bought us blindness. Shape 2, the multiple-step income statement. Definition: it reaches net income in several steps, showing subtotals for net sales, gross profit, and operating income, and it separates operating activities from non-operating ones. Hold the two shapes side by side, and the difference is everything. The single step gives you one subtraction and zero insight along the way. The multiple step gives you the same bottom line, but with checkpoints, a story in 3 acts. Same company, same numbers. Watch. Act 1, the Merchandising Act. Start at the top. Sales revenue $930,000. Subtract the contra family, sales returns, and allowances $20,000. Sales discounts $10,000. That's $30,000 gone. Net sales $900,000. Now subtract cost of goods sold $420,000. Gross profit $480,000. There it is, the number the single-step statement swallowed, sitting proudly on its own line. Gross profit rate $480,000 over $900,000, just over 53%. Act 1 answers exactly one question. How good is this company at its core trade, buying goods and selling them for more? Act 2, running the store. From gross profit, we subtract the operating expenses, the everyday costs of operating the business. Salaries and wages $55,000, rent $30,000, utilities $16,000, advertising $22,000, depreciation $27,000, and freight out $30,000. There's our old friend, shipping to customers, living exactly where we said it would, in operating expenses, never in inventory. Total operating expenses, $180,000. Gross profit, $480,000 minus $180,000. Operating income, some books say income from operations, $300,000. This is the profit from the business you're actually in, before the financial noise. If you want to know whether the store works, this is your line. Act 3, everything that is not the store. Other revenues and gains. Interest revenue $3,500. Dividend revenue $7,000. A gain on selling land $20,000. Total $30,500. Other expenses and losses. Interest expense $1,900. A casualty loss $3,000. Total $4,900. Operating income $300,000 plus $30,500 minus $4,900. Net income $325,600. Same bottom line as the single step to the penny. That's your built-in check. But now the verdict. The multiple step statement shows gross profit, shows operating income, and quarantines the one-time noise where it can't fool anyone. One-off land sale? Next year it's gone. And this statement shows you it was never part of the store. That's why real-world merchandisers overwhelmingly publish multiple step. Take a breath. We built that statement over 3 slides, so here it is whole, the way XYZ actually publishes it. Same 3 lines at the top, who, what, and the period it covers, and on the way down, 4 checkpoints. Checkpoint 1. Net sales $900,000. That is what survived returns and discounts, the honest top line every ratio is built from. Checkpoint 2. Gross profit, $480,000. That one answers a single question. How good are we at the core trade? Buying goods and selling them for more. Checkpoint 3. Operating income, $300,000. That one asks whether the store itself works before any of the financial noise. Checkpoint 4. Net income, $325,600. Everything now, the store and the noise together. 4 checkpoints, top to bottom, and every one of them answers a different question. Here is what I told every student who ever sat in my class. Don't memorize this statement. Read it. Cover the amounts with your hand and say out loud what each subtotal is asking. Do that, future CFO, and you will never mix these two shapes up again. Confession time. Even a perpetual system lies a little. The ledger says what should be on the shelf, but theft, breakage, waste, and recording errors don't scan themselves out. So at least once a year, every company, yes, even with perpetual records, physically counts its inventory. XYZ's ledger shows 70,000. The counters walk the aisles and find 65,000. $5,000 of goods simply gone. The books must bow to reality, so we adjust. Debit cost of goods sold 5,000. Credit inventory 5,000. Retailers call the missing value shrinkage and notice where it hides. Inside cost of goods sold, quietly crushing the gross profit rate. Now you know why stores guard those doors. Every stolen tablet bleeds straight into the number management watches most. Inventory counted. Shrinkage caught. The store's whole year is finally told. One job left. Put the books to bed. Chapter 4. Flashback. The closing dance. And if closing entries feel shaky right now, pause and watch. Chapter 4 first. I've put the card on screen and the link is in the description. This slide will feel easy when you're back. Nothing about the choreography changes. We just have new dancers on the floor. Entry 1, close the credit balance income statement accounts into income summary. Sales revenue $930,000 plus the other revenues and gains. Entry 2, close the debit balance income statement accounts. And look who's in the lineup now. Sales returns and allowances, sales discounts, and the big one, cost of goods sold at $420,000, alongside all the operating expenses. Yes, the contra revenues close as if they were expenses because they carry debit balances. The funnel doesn't care about job titles, only balances. Entry 3, income summary holds net income of $325,600. Debit income summary, credit owner's capital. Entry 4, drawing straight to capital, skipping the funnel exactly like last chapter. Same 4 steps, forever. Final quiz. Build me a mini multiple step statement. Pause now. Sales revenue $500,000. Sales returns $8,000. Sales discounts $2,000. Cost of goods sold $294,000. Operating expenses $126,000. Find net sales, gross profit, the gross profit rate, and operating income. Ready? Net sales, $500,000 minus $10,000 of contras, $490,000. Gross profit, $490,000 minus $294,000, $196,000. The rate, $196,000 over $490,000, exactly 40%. Operating income, $196,000 minus $126,000, $70,000. If all 4 landed, you can read a retailer's statement better than most people who own retail stock. Screenshot this, the whole chapter on one white card. Left column, the buyer's books, perpetual system, buy goods, debit inventory, credit accounts payable. Freight in under FOB shipping point, debit inventory, credit cash, transport becomes part of the goods cost. A return or allowance, debit accounts payable, credit inventory. And paying inside the discount window, the 3-liner, debit accounts payable in full. Credit cash for what leaves, credit inventory for the discount. Miss the window? Then it's the boring version. Debit accounts payable, credit cash, full amount, no discount. One sentence holds the column together. Inventory's cost is invoice, plus freight in, minus returns, minus discounts. Middle column, the seller's books, and the 2-entry rule rules everything. The sale, entry 1 at selling price, debit cash or accounts receivable, credit sales revenue, entry 2 at our cost, debit cost of goods sold, credit inventory, a sales return, 2 entries again, debit sales returns and allowances, credit accounts receivable, and if the goods are resaleable, debit inventory, credit cost of goods sold. customer pays in the window, debit cash, debit sales discounts, credit accounts receivable, pays outside the window, debit cash, credit accounts receivable. The full amount, no discount account needed. Net sales equals revenue minus returns and allowances minus discounts. Right column, the formula, line by line. Beginning inventory plus purchases equals cost of goods available for sale minus ending inventory equals cost of goods sold. 4 variables, plug in 3, solve the 4th. And beneath it, the 2 statement shapes. Single step, all revenues minus all expenses, 1 subtraction. Multiple step, the staircase, net sales, gross profit, operating income, stepping down to the same net income. The full PDF version is free on the site, link below. Tonight you crossed from selling time to selling things. 2 entries per sale, a running inventory account that knows its own cost, a statement that separates the store from the noise, and a closing process you already owned. But I left a landmine in the bucket, and sharp ears heard it ticking. I said inventory is the cost of what's on the shelf. Okay, which cost? You bought tablets in January at $200, more in June at $220, more in November at $240. A customer buys 1 tablet in December. Which cost just left the building? $200, $220, or $240. Your answer changes cost of goods sold, gross profit, taxes, everything. And the wild part? The law lets you choose, and 2 identical stores can report different profits from identical sales. FIFO, average cost. The Great Inventory Costing Showdown. That's Chapter 6. Grab the free exercises for tonight's chapter on the site and drop your answers in the comments. I read every single one, and I'll see you in the next class.